the only stupid thing in here is you.
This asset class is volatile, so it is not safer compared to others.
We are too preconditioned to think that nothing can go wrong with REITs.
I think everyone just look at the title and say, oh, Kelvin hates dividend investing.
All right, so we are back with a sequel. Welcome back to another episode of the Backholder Pod. We have did a two-part series. Basically, I'm talking to Junyuan on the first episode, and on the second episode, I'm expressing our thoughts around dividend investing in general. And since then, interestingly enough, the second episode got more views and more engagement than the first one. So I do encourage all of you to go back to the first video where we had a 1 hour long discussion talking to Junyuan, because it provides a lot more context in our second part of the discussion. But anyway, I think in the second video, there was a lot of comments coming in, both good and bad, both constructive and destructive. So I think we just wanted to go around the table and to provide some of our feedback and basically expand the discussion by a little bit. Because I think in both sides of the camp, those for and against dividend investing, they all have their own preconceived thought, and we just want to kind of bridge both discussions and conversations together. So I think just to start off, I don't know, but who is the biggest bear in REITs investing? But there was this very interesting comments because our title saying that why dividend investing is stupid. This comment from Owls of Sky. I don't know who is it directed to, but the only stupid thing in here is you. Kelvin, any thoughts on that comment?
I think I agree that I'm stupid. But I think it's like what Elon Musk say. I take the position that I'm wrong today, and my aspiration is to be less wrong tomorrow. So I don't think dividend investing is stupid, by the way. It's obviously a clickbait title. It has always a place to play in everyone's, maybe not everyone's portfolio, in some people's portfolio. So if dividend investing is good for you, then go ahead. But for me, who is chasing after growth, then I would take the position that dividend investing is wrong for me.
Actually, Bunti, I wanted to open the discussion, right? So one of the longest threads, right? I'll direct the question over to you. That sparked quite an intense discussion. So I don't know whether it's a he or she, but basically I think along the same lines of, please change your video title to be more respectful of older people who are investing in dividend stocks. Please mention that the stupidity of dividend stocks is for people below 50, because you're offending older people who are investing in dividend stocks to preserve their wealth. Also, think about your diverse audience who are watching your video. Be mindful and respectful. There are three parts to this thing. I just wanted to know your thoughts on this. Firstly, is it disrespectful? Secondly, the idea of dividend investing to preserve wealth, do you agree? And thirdly, I think when you talk about is it an older people thing, only dividend investing is for older people, then it's a right thing. Then for younger people, it's not the right thing. I just want to know your thoughts on this three.
Wow, so many questions. I think this one alone is like 30 minutes. We will just discuss this 3 point only. I'll just say the first is on the title. I think for most of our viewers, right, you just read through the comments, right? I think they have quite a positive feedback on our discussion. But it's just a small handful of negative comments, and that was directed at the title, which is dividend investing is stupid. Actually, we can just rename it, right? We can just call it dividend investing is not stupid. I think it still works, and still will spark all this debate. So I think, yeah, it's a clickbait. So don't take that too seriously. We will consider a win when you guys click into it and watch our video. It's not about whether you're angry or happy reading the title. Then second point that I want to touch on, yeah, I think on safer asset class, I won't make that kind of claims. I think it's a bit misleading here, because whether you invest in growth stocks or dividend stocks, right, actually they both can tank, because you're essentially investing in equity share class, right? Equity means that the worth of the shares, right, actually you have to pay out the debt, then the leftover is absorbed by the shareholders, right? So they actually take a lot of risk, although on the surface, you just look at the dividend streams, it looks stable, but actually the capital structure wise, it's not really a stable investment. That's why many people say, if you invest in dividends, please have a long-term short-term horizon, and then don't invest the money that you need over short-term period. By short-term, usually we are saying that within 5 years, if you need the money, you shouldn't put into REITs or dividend stocks or any stocks, right? So I think that's something that I want to highlight. And then the third one I have quite an opinion is that I don't think dividend investing is only for the people who are old, because if you pay attention, right, like for example, the Aaron guy, right, our content creator friend, he also shared his portfolio, and if you just look through his portfolio, it's almost, you can call it like dividend portfolio, right? Although it's not 100%, but still sizable portions are invested in dividend stocks. And also Kelvin shared in a previous episode, he started out dividends before he went into Tesla, right? So I think Kelvin was younger back then, but he's still open to dividend investing, right? If you look around, I think there are quite a number of young investors that are interested in dividend stocks. So I don't think this is discriminations on the age. Yeah.
Hey, for Bundi, just now the second comment, he mentioned that dividend investing is less, he don't think it's less risky as compared to other. So you mean it's the same risk as compared to other kind of investing?
Yeah, it's not same risk, it's the different type of risk. Because for dividend, right, for example, if you buy dividend stocks, you are happy with, let's say, 6% dividend, right? It could be REITs, it could be other companies. But let's say for whatever reasons, REITs, it could be like, occupancy rate got affected, or if you are investing in banks, it could be interest rate move and so on, right? As long as your earnings drop and then the companies need to cut the dividends, then your share price will move together, right? So it's like, we don't have to imagine this. You just look at the REIT index over the past, let's say 3 years, right? It actually dropped by at least, like 30, maybe 40 or 50%, right? So, this asset class is volatile, so it is not safer compared to others. It's just that when we contrast this against, let's say, like growth stocks, the type of risk is different. For growth stocks, usually it can run up as long as they can produce the growth, right? You just follow the revenue, keep on going up, then share price usually is very positive. But the moment the growth disappoints, right? Disappoints meaning that it's not like growth drop to zero. It just grow less than the market expected. Then the share price can also tank, right? So it's different type of risk. I would say that one is safer or one is riskier than the other. It's just that they are subject to different type of risk.
I think we also shouldn't forget that when you say investing, right, meaning when you're putting your money in the equities market, meaning you're buying equities, right, you are always taking some sort of market risk or recession risk, whatever risk. And even if you say that you buy into an index because you want it to be diversified, there is still asset class related risks. And a lot of people are being sold the idea. I think on one part, the marketing is done very well, that you are being in this fortified asset that doesn't seem to go anywhere. Of course, with some logical backing as well, because the real estate is there, you can see and touch, you can go down and feel, compared to a lot of these so-called growth stocks with intangible assets. Like Apple is selling you what? You keep saying, oh, there's a moat to the ecosystem, but you can't see, you can't touch. And there is so-called a valuation premium for many of these so-called growth stocks. On the flip side, you are still also exposed to many of these reinvestment and as in REIT valuation and risk, so-called investment risk. And I just want to mention 2 comments in the whole long list of thread of comments. So from Casey Chin, he or she said that very good discussion. Buying REITs is the same as investing in property. Not only the yield is important, the appreciation of the property value is more important. Any negative property transaction will be impactful and detrimental. What kills a REITs is often the devaluation. And a second comment from Radical Z Deron, SG REITs as an asset class was born just pre-GFC, global financial crisis, as a way for property developers to recycle their capital and sell to retail investors their buildings at full valuation. It did well throughout the low interest rate environment, but as a result, many SG investors lost sight that true wealth was being made from the companies with intangibles rather than tangibles. Agree that REITs may not be good for a long time when bond yields are already so low, if I'm not wrong. Yes. So just wanted to go around the table. Eric, what's your thoughts on these 2 comments?
Well, the comments very long. By the time I want to say something, I forgot what the comments say already. Okay, but I think I remember reading this comment. I thought it was quite insightful, like the REITs thing. Because REITs is quite a recent phenomenon, I think, even in Singapore. I think US had it first. Then we had it like maybe year 2000 or 2001, 2 or 3. Yeah, I remember the first one that came out, Capital Mall, right? Yeah, was considered quite premium because the brand name was good, ma. So everyone bought into it. I think at the time, IPO was $1. And it did pretty well for maybe, say, about 10-ish years. And then the low interest environment propelled it even further, $2 plus. It was doing okay. And I think it went pretty high also. And then the dividend yield also good. Then, so nothing much to complain about until the low interest rate ended. Yeah. So I think like we are too preconditioned, I would say, like what the comments say, we are too preconditioned to think that nothing can go wrong with REITs. And actually, I think personal opinion REITs is not really like a real property, because real property you have it under your name, you can control, but REITs you can't, and there's so many tenants, so many variables. Wow, a lot of things can affect the income of the REIT. So I think it's not really an apples to apple comparison. And I suggest that we don't think in this manner. It's not a substitute for having a real property under your own name, which I think you can do a lot of things with it, right? If it's under your name. Yeah. So you can sell it, you can whatever, rent it out and all those things. But REIT, you can't. And they want to raise money from you, right? You kind of suck thumb. Yeah. You cannot say, oh, I don't want. You don't want, then you get diluted, lor. Yeah. So that's the thing that I most hate about holding REITs. Every time they want to raise funds and then they stretch out their hands like, hey, remember we give you a lot of dividends? Return it now. Yeah. So I think that's the part that I don't really like so much about REITs.
Hey, but Eric, you bought some REITs, right?
Yeah. I've been holding it because I don't want to say that my wife wants it, but I can't really. It's not really up to me whether I want to sell it or not. So it's like just keeping it there, lor. So if they want to raise any rights and all that, luckily the position are still not that huge. It's gonna be like a few $1,000s. So I think it's still fine for us. But I won't want to make it like a integral part of my portfolio. I want my portfolio to be like Bunti, right? Going up 10 times without asking me for money. That's nice.
Wait, sorry, Bunti, do you have REITs now? REITs exposure?
Liquidated few years back, right? So
Oh,
actually we discussed about
Best
REITs
market
not
time.
too long ago. I think this year also we discussed, and I always say that REITs at current environment, I'm still very skeptical. And my concern is always on the interest rate, because interest rate doesn't need to continue to go up. Even if it stay its current level, it still put on a huge pressure because of financing costs. And we discussed this at length, right, during the discussion.
But don't you think like REITs has now dropped to so low? Isn't it a good time to buy now?
If I just look at a few, the larger REITs, right? I think the larger one is still okay, because if you just look at the ratio of their total assets versus their debts, right? The ratio of that debt is lower. That's the good sign. I think the smaller REITs, those that tank quite a huge percentage, right? Those are like they have a higher debt ratio. And then the second thing is that I will look at the debt, right? See whether they are financing through a fixed rate, or is it something like floating one? Because for example, some they just stated that they have some medium term notes, something like the MTN, right? And then you look at the rates, right? It's like it can go up quite significantly just compared to a few years back. So you cannot expect that the kind of dividends that they get, right, will able to sustain if interest rates just stay high at current level. So that's my main concern. Yeah, need to look at the debt profile. So it's not a simple study. You need to look into details. And second thing is also you need to pay attention to whether their rentals can increase. And this one really depends on occupancy, depends on whether they can increase the rental. One observations that I have, right, on occupancy, right, is that sometimes when I go to some, like let's say restaurant, right, or even, I mean, just any shops, sometimes you see that it's not just one shops that's closing down. Yeah. When things are closing down, it can be like 2 or 3 or 4 business just close up at one specific location. My guess, right, usually is that, okay, must be, you know, like all these not tenants, the landlords, right, increasing the rentals, and then the tenants cannot take it anymore, so they have to move out, right? So this one just shows that sometimes the REITs manager, although they say they can increase the rent, right, but your tenants may not able to take it, so they will just move. So it just shows that it's not the economy, all these things is not like super bright lah. Like their financial positions may not be as strong as what is shown on the surface.
Actually, the other thing is that our title mentioned about dividend investing. So it's not just about REITs.
Yeah.
It can also be about banks, right? So if you got banks and REITs in your portfolio, wouldn't it balance out each other?
I do think that it is a good balance, because one will benefit from higher interest rate, the other one will suffer from high interest rate. So that's why I think Kelvin, you just released the video on STI ETF, right? So it was flat for quite some time, but actually if you look at the underlyings, right, you'll notice like names like DPS, which is one of the top holdings, right, dividend stock some more, is doing very well, but the REITs are doing not as well, so they balance out each other. I think that's quite interesting.
So that's counted ETF investing, or that's counted dividend investing?
Dividend.
Dividend. So STI is a dividend investing strategy.
Yeah.
Okay.
I think so.
Okay. Another comment from Andy. I think Bunti has replied to Andy as well in the comments, but I think generally he's asking with regards to the theory of drawing down retirement funds as opposed to dividend. What's the view of having, let's say, 4,000 shares of Tesla, total 1 million, and you need to draw down 50,000 yearly compared to receiving $50,000 in dividends? I just want to ask psychology, selling 200 shares yearly, maybe lesser when price goes up or more when price drops. In practice, does the 4% rule stresses you when you keep seeing the total number of shares dropping yearly? Kelvin, any thoughts on this? You're the closest to having the biggest Tesla exposure, right? Will you be adopting this strategy?
No, actually, I'm planning to eventually convert back into dividend investing. It wouldn't actually stress me out. So the example that he gave is a bit off because of fractional shares. So Tesla goes up, you're selling just 4% of the portfolio of your holdings. So technically, let's say if a stock, not necessarily Tesla, if a stock goes up, then you only sell 4%. Each time you sell 4%. So technically, you won't ever run out of shares to sell because of fractional investing. It wouldn't stress me out because the total value still keeps going up.
I think it's not fractional or not fractional. It doesn't need to be fractional. It just needs the share price continue to go up. Then you are fine, right?
But he's talking about the total number of shares going down. But in this case, if you include fractional investing, technically you own unlimited shares. I don't know if in terms of decimals points, yeah.
If I can share, right, actually, there is a wrong premise on this question, right? Because the whole idea of a 4% rule that was constructed in the first place was on a retiree portfolio based on a 50-50 split or 60-40 split, if I'm not wrong. Meaning 50% equity, 15% bond, or 60% equity and 40% bond. Then you have to tweak the allocation more and more when you start to get older and older because you can't be affected by the volatility. But then today, when you put into, let's say, a particular stock, which is there's idiosyncratic risk, there's market risk, there's whatever risk, and then today suddenly something happened to robotaxi and then it shoots to the moon. Tomorrow the pay package, something happened, then it comes down. That's not how you work the 4% rule on a one stock portfolio. Then you start to draw down 4%. So I guess you can argue that back in 2022, both equities and bonds tanked, but it shouldn't be the case lah. Normally, in normal finance literature, is that they should kind of hedge each other. And in a good market year, bonds will just pay out a normal way, as in a fixed amount, the yield. And then if you need to top up, you maybe sell a bit of equities because the stock market is going well. But in a down year, when equities are down, you are still protected in a way because of that bond yield, or you can basically sell some of your positions in the bonds because it should technically not go down by a lot, and then let your equities hope for it to rebound in the future years. So that was the idea of how the 4% rule experiment was conducted. And then they test it throughout like the last 50, 100 years. And then they realized that 4% was the magic number that you can draw down. And there is a very high probability that in any sort of sequence, you can still tide through the whole retirement lifestyle. So that's a bit of the like backstory. But then going back to the point about if you want to retire and you still hold 4,000 Tesla shares, then I only can say you are very powerful and you are very confident that Tesla will moonlight in a way.
Yeah, so that's why the second part is for me is to switch back to dividend investing. So the first part, the reason is first, okay, obviously it's lesser volatility lah, technically. Yeah, because I'm getting the dividends and not relying on selling the shares to get my income. Then the second thing is because US stocks has this estate tax. Once I get old, eventually I will pass away. So if I continue holding US stocks, I'll be exposed to up to 40% estate tax when I pass away. So by switching back to dividend investing, I will first get to avoid estate tax, and second, I will get to avoid forex fluctuation, currency fluctuations. So everything plays a part. That's why I say.
I just want to quickly come back to Chiking's comment. I think this one, if you watch some of Keith Investment Mode's article or his video, right, he also mentioned on this. There's a lot of nuance on this 4% rules one. I think the sequence of risk that you just mentioned is one of the key one. Don't talk about like single stocks. Just looking at, let's say, like a broad US stocks versus bonds, right? Let's say 50-50, doesn't really matter. But if you just run through this exercise, these calculations for different time period, right, you'll notice that there will be some period that you are doing extremely well compared to some period that they are doing extremely bad. And those extremely bad one is not like their average return is a lot lower. The problem is, the bigger problem is on the sequence. Because what happened is that, let's say if you are drawing down from your so-called like the volatile assets, right? You just need to have a certain years, let's say 3 years of underperformance, and you still need to draw out the same amount of money, right? So you are essentially need to liquidating a huge number of shares. And once you liquidate that huge number of shares, right? The subsequent rebound in the stocks, right? Is you don't get to enjoy that part already. I think that one is a big problem. That's why when they run the study, they will notice that actually there are those that are unlucky, like you strike the wrong period to draw out the monies, right? Your net worth will actually a lot lower as compared to those who are the lucky one. And this sequence of risk is not something that you can control, right? Because you can still say that, oh, on average, the return is still about the same. But why one person can end up with, let's say, 10 million's net worth after 50 years, then the other person is like left with like negative, right? So the money actually burned out before the end of period. And this whole thing is true for broad investment. And imagine that you just put this one into like specific stocks, right? The volatility is a lot higher. So the sequence of risk things is even more obvious, more pronounced. So I think that one just need to be aware of that. It's highly not recommended to do these kind of things, especially on a concentrated portfolio.
That's why a large part of retirement in this case, like the initial comment from Lee, was talking about trying to preserve wealth, right? If the entire idea of preserving wealth is to make sure that you don't care about sequence of returns and making sure your initial capital is there, and if you're a Singaporean or a PR in this case, there is a very good tool at your disposal, which is CPF. You have the backing of the Singapore government and the full faith of the entire workforce that continues making this machine continue running. So that this whole idea of dividend investing or whatnot should not be like your primary go-to. The CPF should be your, like Mr. Lu says, your base of your retirement planning. Then you start to layer on different other structures. But yeah, I think it's just, I guess, a very big contention here is really the idea of investing in dividend stocks. Is it a superior way to get out cash flow rather than operating on a discretionary basis where you sell your portfolio? Because I think it goes back to my point again the other time in the previous video, was that yes, you can extract the same amount of income, whether is it you sell the stocks or the company pay you, but your net worth ultimately still took a hit because at least for the last 3 years, the REITs ETF, let's not talk about individual stocks, an ETF holding the top few stocks or top 20, top 30 REITs, your net worth still took a hit at 30%. And then you are telling yourself that it's okay, I'm fine. It's the REITs will come back. But it's the same thing. You sell the S&P is also there. It's just that lesser, true, but S&P will come back also. I mean, that's my logical, that's my interpretation of this whole this differences. But yeah, anyway, I think there is maybe 2 or 3 more comments. Kelvin, it specifically call you out. So, Kelvin started with dividend investing. Since his pivot to chasing Tesla, he has been bashing on dividend stocks. Growth stocks is for people who want big growth and young to wait it out. Example, Kelvin. Naturally, he also suffered the consequences of it. Just look at his Tesla portfolio the past year. Kelvin, any reaction to these two comments?
If I want to relook at Tesla portfolio today, I mean, I think everyone just look at the title and say, oh, Kelvin hates dividend investing. Where in fact, I keep repeating over and over again that I don't hate dividend investing. So it's the same like chou tofu, right? Not everyone has to like chou tofu. Maybe some people like because it's smelly, but I don't like because it's smelly. It's the exact same thing that you don't have to like something, and you don't have to force other people to like the thing that you like. I think that's the thing about growing up, right? Growing up means that you are able to take both sides of the wheel and accept both sides of the wheel. So I mean, dividend investing has a place to play. Maybe not just in old people's portfolio, but also maybe I think Chicken also has some REITs right now, right?
Small.
Yeah, so it's everyone has some people like REITs, some people don't like REITs. So yeah, I'm not bashing REITs. You just check how many REITs videos that I've done already. If I hate it, I won't even look at it, obviously. So yeah, as for my Tesla portfolio, it's always the same thing. When it goes down, all the bears come, oh yeah, see, I told you so, Tesla is going to $20, otherwise I'm going to quit YouTube. And when it comes out, everyone is so quiet. Then now all the bulls come out, see, how come you bash Tesla when Tesla is at 100 plus? But notice that I've kept quiet throughout the whole thing. So it's the same thing. You don't have to force everyone. I don't have to force everyone to like Tesla. Likewise, I don't have to force everyone to like dividend investing. So yeah,
I think that sums up very well from Kelvin. We hope you guys take this video in good faith and do understand that I think at the end of the day, when we are creating content or when we are discussing something more trickier, when both sides of the camp have very strong opinions, right? And we ourselves have strong opinions and strong exchanges, it's better that more people get a chance to click into the video by whatever means, compared to we spend a lot of time, a lot of effort to extend the discussion, and we think that this video is of very great value, but at the end of the day, not manage to get people to click into the video. So no matter how good your discussion is, it doesn't matter because nobody's watching. So I do hope that especially for people that don't really or saw the title and have a preconceived idea, do watch it through. If you think you're very busy, you can watch it at 2 times speed. I think it will mostly take you 15 minutes or so. And then you can have a refreshed conversation again in the comments down below. With that, we'll see you guys in the next video. Goodbye.